Good morning, Professor Mantana. Today, we'll present about our investment project, where we analyze and develop portfolio strategies under different scenarios based on the given case. Starting with scenario 1, we construct an optimal portfolio based on risk-return efficiency in the Thai market. The allocation is heavily concentrated in LB356A at 85.4%, with a smaller position in Delta, ALT, and BH. This reflects a strategy that prioritizes stability while selectively capturing growth from high-performing equities. As a result, the portfolio delivers an expected annual return of 10% with a Sharpe ratio of 1.84, which is the highest among all scenarios, and a very low risk level of 5.43%. Overall, this portfolio is designed for investors who seek strong risk-adjusted returns with minimal volatility. Moving to scenario 2, this portfolio follows Warren Buffett's investment philosophy, focusing on fundamentally strong and resilient companies. The allocation consists of 60.81% in SGOV, supported by 22.25% in ExxonMobil and 16.94% in Microsoft. This combination balances capital preservation with companies that have strong cash flow and durable competitive advantages. This results in an expected return of 10.01% with a Sharpe ratio of 1.23 and a moderate risk level of 8.17%. Overall, this portfolio emphasizes long-term value investing with stability enhanced by safe assets and growth driven by high-quality companies. Finally, in scenario 3, we applied Peter Lynch's GAAP strategy, which focuses on investing in companies with sustainable growth at a reasonable price. Based on this approach, CPO, AOT, and BDMs serve as the main driver of this portfolio, reflecting a strategy that is fundamentally designed for stable and long-term growth. However, within a short investment horizon of just 5 days, the portfolio recorded a loss of 0.75% or 348 baht from an initial investment of 46,320 baht. This result doesn't necessarily reflect the weakness of the strategy, but rather the short time frame and possible market volatility, which limit the ability of long-term growth strategies to fully realize their potential. Overall, this scenario highlights that while GAAP is suitable for sustainable investing, it requires a longer investment horizon to generate consistent return. So moving on to scenario 1. Given the ongoing tension between Iran and the US in the Middle East, we are seeing some pressure on global production costs, including in Thailand. So in this portfolio, we have leaned toward Thai equities that are relatively resilient in uncertain environments. The focus is on defensive names like BH and CPO, complemented by sustainable growth plays such as Delta and ALT, and a value exposure through PTTEP. Since our target clients are in 45 to 65 age range, we prioritize companies that are with solid fundamental and more stable earning profiles.
And here is our asset allocation of scenario 1. And now let's talk about the analysis part of scenario 1. We would like to inform you the detail of each stock. The first one is Bamrungrad Hospital. This business is driven largely by international patients and is well recognized for high quality medical service, while geopolitical tension could impact patient flow from the region, but in overall fundamental remains strong. Next, let's move to the second one, CPO. It is a Thailand dominant retail player with its extensive logistic network and highly recurring revenue base. The business remains very stable as the operator of 7-Eleven store with the largest store network in the country. The third one is Delta operation, the Delta Electronic Company. Delta operation in the B2B space, with core revenue coming from EV components and power solution for data centers. The company also invests significantly in R&D, which position is well to capture long-term technology-driven growth trend. Next, the third one is Airports of Thailand or AOT. This is benefit from a near monopoly position as the operator of Thailand major airports. Its revenue stream from passenger service charge and aircraft-related fees are strong and consistent. Combined with Thailand is a top global tourism destination. This supports continued growth. The next one, let's move to PTTEP. This is a part of the PTT group focused on upstream oil exploration and production, with long-term contract with PTT as its key customer. Its cost structure is sustainable. This means that during the period of rising oil price, particularly in time of geopolitical conflict, these companies tend to be benefit. And the last one, let's move to risk-free assets. This is a Thai government bond maturing in 2056. Its name LBT56A. Given that it is government backed, the default risk is minimal. It's denominated in Thai baht and serves as a suitable low risk component for more conservative allocation. And from all of this talk, now let's talk about the result of scenario 1. The first result is we focus on FARP. There is no allocation to CPO or PTTP, but the portfolio is concentrated in Delta, AOT, and BH. It offers a strong Sharpe ratio of 1.53 and expected return around 56.87%. However, this comes with high volatility with a standard deviation of 37.16%. But we have the solution to make it better. So let's move to the result 2. To better manage risk, we combine fund P with the government bond. The optimal allocate is approximately 85.4% in LVT56A and 14.6% in 5P. This improves the Sharpe ratio to 1.84 while reducing volatility to around 5.43%. Although the expected return moderate to about 10%, the overall risk return profile becomes much more balanced and risk is more suitable for investors.
For scenario 2, our group focused on investment in the US market. The main idea is to invest in high-quality company with strong fundamental, stable cash flow, and long-term value. For this scenario, we consider several US assets: Microsoft, S&P Global, ExxonMobil, Visa, and STOV. For asset allocation, after considering this US asset, the optimization model selected the best portfolio allocation based on target return and risk level. As shown in this slide, let's move on to the detail of its stock. Starting with Microsoft, it had a strong business mode. Its products such as Windows, Office, and business software are widely used around the world. This creates revenue, strong customer loyalty, and pricing power. Next is S&P Global. This company provides credit rating, benchmark, analytics, and financial data. It is important because many companies, investors, and governments rely on its information. This gives S&P Global a strong competitive advantage. Next is the ExxonMobil. It represents the energy sector and adds diversification to the portfolio. Since energy company can move differently from technology or payment company, XOM helps reduce dependence on only one sector. It is also a large company with strong cash generation. The fourth company is Visa. Visa operates one of the largest payment networks in the world. It benefits from growth of digital payment and has a strong network effect. Lastly, STOV is included as a risk-free asset. It invests in short-term US Treasury security, so it helps the portfolio and lower volatility. For the first result, the stock-only portfolio gives the highest expected return at 22.44%. But it also has high risk at 22.51%. This is because the portfolio is heavily concentrated in Microsoft, so its performance depends a lot on Microsoft movement. For the second result, after adding the STOV and setting a minimum return of 10%, the portfolio becomes more conservative. The expected return decreased to 10.1%, but the risk dropped significantly to 8.17%, and the Sharpe ratio improved to 1.23. This means the second portfolio gives a better balance between return and risk. SPGI and Visa are not included because under the minimum risk objective, SGOV, XOM, and MSFT provide a more efficient combination.
Finally, when comparing with Buffett portfolio, the US stock portfolio gives the highest return, but also comes with highest risk. So it is more aggressive. The US portfolio with SGOV gave a low return, but it has the lowest risk, has better stability. Therefore, both portfolio outperform Buffett return, but the SGOV portfolio provides the best balance between return and risk. Next, moving to the third scenario, a common strategy of investment by Peter Lynch, a manager of Magellan Fund, who make an annual return at 29.2%. His strategy is to grow at a reasonable price, so we are seeking company with a sustainable growth and deep competitive mode at a fair valuation. To predict our capital while ensuring growth, we look at for the company that dominate the Thai market. Based on the said market, we identify three powerhouses, which is CPO, AOT, and BDMS. CPO is the undisputed regional powerhouse, also owning the 7-Eleven network. Their supply chain and market share make them as essential part of Thai daily life. AOT represent a pure monopoly. As the sole operators of Thailand major airport, they capture the massive influx of global tourism through landing fees and service charge. BDMS provide a healthcare ecosystem, over 50 hospitals, and a hub and spoke model for high-end medical tech. They have a market advantage that competitors simply cannot match. For this scenario, our allocation was weighted at 71% of AOT, 21% of CPO, and 8% of BDMS. This distribution was designed to prioritize the most unshakable monopoly in the market while balance the high-frequency ratio and defensive healthcare. We executed this strategy over 5-day window from 16 to 20 April 2026. Now let's look at the result. The portfolio recorded at a realized loss of 348.37 baht, representing a 0.75% decrease from our initial capital of 46,320 baht. In a Peter Lynch strategy, the reasonable price is a long-term play. Our duration of only 5 days was simply insufficient to generate capital gains that could offset the initial transaction cost. In the short term, commission and market noise often make the underlying strength of the asset. This is the end of our presentation. Thank you.